You've probably heard advice like save 10% for retirement and you'll be fine, or you have to pay off your mortgage before you retire. And while on the surface that sounds smart, we could do a whole lot better. You see, these generic financial advice rules of thumb are putting your retirement at way more risk than you realize because it's not personal, it's not tailored to you. And so in today's video, we're going to break down 4 common pieces of retirement that I see and I hear all the time and why they're not only outdated, but they could actually be doing your retirement plan way more harm than good. So after working with retirees for a number of years, I've seen firsthand why so many of these golden rules that we grew up with simply just don't apply anymore, especially not in today's world of higher costs, higher inflation, longer lifespans, and volatile markets. And so instead, I want to show you how to make retirement your own, how to personalize it, and how to optimize your retirement here in 2025 so that you could retire with confidence, clarity, and control. Without further ado, let's dive in. The first rule of thumb that puts your retirement plan at risk is the blanketed advice to save 10% of your income. Yes, savings never a bad idea, but 10% doesn't mean anything. It's arbitrary. It needs to be specific to you and your plan. You see, your retirement, therefore your saving plan, needs to be just as unique as you are. And it should be tailored to your goals, when you want to retire, your lifestyle, and how much you want to spend. So for higher earning couples, we'll say those making $200,000 or more, 10% is not even going to get close. That's $20,000, especially if you want to retire early. And so what we're going to do is break down an example in just a second of what that looks like instead. But worse, this rule doesn't even tell you where to save. And in my experience, I see way too many people dumping everything into a pre-tax 401k, setting themselves up for a massive tax headache later on down the road. Think required minimum distributions. So here's what I want you to do instead. And it starts with knowing your numbers. So let's say you need $100,000 a year in retirement to live comfortably. We'll say Social Security between you or maybe you and your spouse brings in $40,000. So now we need $60,000 a year from our portfolio. Well, using a distribution rate between 4 or 5%, you're going to need somewhere between $1.2 and $1.5 million before taxes. And if we factor in, say, 20% for taxes, well, we're looking at closer to $1.8 million. So if you have $1 million now and you're somewhere between 5 to 8 years away from retirement, 10% is not going to get you there. We need closer to $30,000, $35,000 of savings to get to that $1.5, $1.8 million figure at a 5% return, which is closer to a 16% savings rate. Now, second, you're going to want to have a tax plan for where to save. And I made an entire video on this particular topic, but in short, the more diversity you have amongst your investment accounts, the better. So yes, have your 401k, that's great, get your tax deduction for contributions, but you're also going to want to think about having a brokerage account because it's going to be taxed at capital gains. In retirement, when we take distributions, you're also going to want to have a fully funded emergency fund and then some in the bank and even a Roth IRA. It's all about having that optionality and flexibility. So bottom line here, don't follow a percentage. Follow your plan. Know your numbers. The second dangerous piece of generic retirement advice is that you have to have your mortgage fully paid off before you retire. And that if you don't, then you should drop everything you're doing today and put every extra dollar, not towards savings, but towards paying it off. It's not the case. I love the idea of being mortgage free heading into retirement. It's a great thing. A lot of flexibility. You could spend more, less stress on your investments, but not if it comes at the cost of fully funding your retirement accounts. Remember, it goes back to point number 1 in your savings rates. You need to know your number. You need to know how far away you are from hitting that retirement savings goal. And your retirement savings goal, if you're not there, it takes priority over your mortgage and paying it off. Because having a house that's fully paid off, that's just icing on the cake. It's a nice to have, but we got to make sure we have enough to live from our investment assets. I understand there's a lot of nuance when it comes to this particular topic. Anything above 200, 250,000, this warrants a separate conversation, but in instances where you could see the light at the end of the tunnel, with paying off your mortgage within the next few years, then the conversation becomes what's your interest rate today and how much have you built in terms of your portfolio and your net worth towards your retirement goal? Because your house is an asset, right? You could always cash it out, especially if you're living in a higher cost of living area like California, New York, Hawaii. You can do what I call geographic arbitrage. That's an asset. You could sell it even with a mortgage and downsize to a smaller house, or somewhere else in the country. Now, speaking of assets, if you were fortunate enough to lock in a mortgage rate under 4% during the pandemic, that's also an asset. This is good debt because in many situations, you don't need to pay down your mortgage faster. Keep it on the balance sheet and use that additional savings to put into the market and grow at a higher rate. So this is where we have to have a plan because we don't want to blindly throw every extra dollar at our mortgage, but instead we want to run the numbers. Because look, if cash flow is tight, worst case in retirement, it only works one way. We could always refinance. We could always stretch out the terms of a mortgage to create more cash flow. We can't do the same thing with our investment portfolios. We have to know our numbers and figure out with that additional savings while we're still working, where does that fit in our overall plan? Now, as you make your way through this video, if you've been following some of this generic advice and you now have questions as you approach retirement of how do I create a plan that's personalized to me, what I want you to do is click on the link in the description below. You'll fill out a survey answering some basic questions on your situation and your retirement. And what we'll do is make you a personalized Loom video that's specific to you, that's tailored to your needs, your retirement timeline, answering all of your questions. Now back to our video. Speaking of investing, one of the most dangerous mistakes I see is that when retirees try and avoid the stock market altogether once they retire. It's as if they don't want to take on any more risk and they throw out their entire playbook and they dig their heels in the sand and go super conservative. But what got you to the point of being able to financially afford to retire? I'd guess for most people, it was decades of disciplined saving and investing in this very market that you're now scared of. And I get it. No longer contributing to your retirement and pulling money out, right? Going the other way, it's a scary and big transition. After all, what if there's a terrible market crash or a recession right after you retire, right? Just my luck. Well, like with anything, you have to have a plan that's resilient and accounts for these things. This is why we stress test, we run Monte Carlo analysis, and we have to modify our investment portfolio to now look a little different than when we were working and adding money. It's got to be able to have one that is hedged towards both growth and protection. And second, we have to have a spending plan to understand how much we could spend in good markets and in bad markets. And an important part of retirement investing is learning how to group or segment our money within our portfolio into years or decades. And so money we'll need in the next 1 to 3 years. Let's not take any risk on that. I get it. It's risky. Don't even risk it. But what about the money 5 to 10 years from now? Well, we could take on a medium amount of risk and money for your future self in your 70s, 80s, 90s. Well, we could afford to take on more volatility because that's going to lead to longer returns. If we're too conservative, here's the thing most people miss. It's a double whammy. Not only do we miss out on future growth, that's strike one, but we also miss out on the compounding of that future growth. Right? Research will tell us that 8 in every 10 years, markets have more good years than bad years. And so not only are we missing out on that year of growth, but if it happens consecutively or more good years than bad years, we're also missing out on that compounding growth. So that's strike one and strike two. And strike three here is not being able to keep up with the rising costs of inflation, living expenses by being so conservative. And so like I mentioned earlier, it's having that segmented or what I call that bucketed strategy, which I'll share here on the screen. So we need to know our numbers. And let's say our living expenses. Right, we need $60,000 a year from our portfolio. Great, put $60,000, $120,000, $180,000 in cash, in very short-term liquid bonds. That's not going to take on a lot of risk. It's going to grow a little bit, but it's going to be safe. It's going to be stable. It's going to be consistent. Money that we'll need years 4, 5, 6, all the way out to 10. We could take on a balanced amount of risk between short-term bonds, intermediate-term bonds, maybe some global bonds, as well as our equities. And like I said, money 10 years from now, we can afford to take on more investment risk through diversified markets. Because guess what? As markets have more good years historically than they do bad years, as we have those better years, we can backfill our spending with the growth from markets. It's like a cascading waterfall. And so we have to understand what our numbers are. We have to have a spending plan. And then we need to be able to segment or bracket our investment risk based off when we're going to need the money by. So it makes absolutely no sense that we would just completely get out of the very market that got us to this point. We have to have a plan. And again, it's got to be specific to you. The fourth, just plain out bad and generic piece of advice that I see is to claim Social Security as early as possible, right? At 62 because it's going away. And first, that's just categorically false. It's not true. Social Security is not disappearing. Yes, the trust fund is projected to run out and be depleted by 2033, but even then, 77% of benefits can still be paid out from ongoing payroll taxes. That's just if Congress does nothing. And I think they're going to get something accomplished. And in fact, I made an entire video on this very topic. Now, if you claim at 62, you're also locking in a permanent reduction of up to 30% forever, right? For every year you take it early, take about an 8% haircut. Whereas if you delay for every year after your full retirement age, at 67 for most folks, for every year after that, it grows by a guaranteed 8%. Again, guaranteed, which that is very difficult to find in the market. And those higher benefits, they're not just for you, they're for spousal benefits as well. They boost that, as well as survivor benefits. So it comes back to having a plan and figuring out how much is Social Security going to be a part of our retirement plan and when should we claim. Not to mention the cost of living adjustment that's pegged to inflation when it updates every year. If you have a larger Social Security check, guess what? That same COLA percentage that gets adjusted, that goes further dollar for dollar on a larger benefit check than on a smaller one. And what I love too from a tax planning side is while you wait, while you defer your Social Security, it creates more lower income tax years, right? That golden window that I've talked about, where we now have more opportunity for Roth conversions and other tax planning before Social Security kicks in. So again, it comes to having a plan, knowing our numbers and where Social Security fits in. Rather than just blindly following arbitrary advice, have a plan, because Social Security is going to be one of the most important decisions that you make in your retirement, which over the long run, we'll say 20, 25, 30 years, could amount to tens, if not hundreds of thousands of dollars worth of a difference. Now that we know what not to do, let's do this instead. I've said it 1,000 times, but I'll say it once more. It starts with knowing your numbers and what you plan on spending today and in retirement to determine how much you need to have saved. So to do that, let's work backwards. Start with what you have saved today. Figure out with those spending numbers how much you need to get to, solve for what you need to have, and come up with a plan to save that missing amount in the given number of years before you retire. This is how you build your savings plan and can figure out how close or far away you are from retirement. And remember, when you're doing this, factor in future expenses like healthcare, taxes, travel, and inflation as well to make sure your plan is stress tested. Next, we want to be able to have a plan for where to save, right? This is location and being able to have that tax or investment flexibility by not just having all of our assets in that pre-tax retirement account, which is going to lead to a tax bomb later on, but being able to have flexibility to be able to pull money from a brokerage account, savings, tax-free, or even a Roth IRA. And the next thing is we want to figure out with our retirement income, having a plan for the timing of Social Security. We have to figure out what's most important and what makes the most sense for you and your family. Is it maximizing your combined benefits? Is it creating a tax window, that golden window in retirement to delay or defer Social Security to do more tax planning? Or is it to maximize survivor benefits? Whatever it is, it has to be specific and fit in your plan. And the last one, with your investment strategy, it needs to change and update with you in your retirement. And so when you're younger and as you are leading up to retirement, you can take on more investment risk, but it should change and adapt as we start getting closer to needing our money. Remember, our investment plan should be dictated by how soon we need our investment income. That's right. Our cash flow should determine our investment allocation. So there you have it. 4 pieces of retirement advice that you can absolutely ignore in 2025, and instead what you should be doing to build a plan that is personalized to you and your situation. And again, if you have questions, you want us to personally review your plan, click on the link in the description below and we will send you a personalized Loom video that outlines exactly how to modernize your retirement plan for today. I'm Nick Covio with Swell Financial. Thank you so much again for watching. I'll see you in the next video.